Hey everyone, and welcome to the month of May. So let's talk about 4 companies that should be on your buy list or maybe just your watch list in the month of May. Now, since we are in the earnings season, just because I'm posting this right now does not mean that these are absolute buys right now at this minute. No, actually, you will have probably plenty of time to maybe even have a better entry points in the coming weeks. So let's talk about 4 great companies without wasting your time. Here they are. I do hope you keep watching, and if not, at least leave me a like and a comment. Would really appreciate that. And if you're new here, there is a very big discount happening right now at FinChat, 25% off, a link in the description and in the pinned comment. More on them in just a bit. All right, so company number 1 is Bookings Holdings. This company just reported their latest quarterly figures, and right now, as you can see, the stock is basically flat, whereas the whole market at the time of making this video is red. This is a company with a market cap of $160 billion, trailing 12 months PE of 28.3 times, and a forward one of 22.7 times. As you can see, over the last 12 months, this stock is up 41%, so definitely a market beater. High margin business as well, gross margin of 85.9%, free cash flow margin above 33%, so very good company. If we look at the growth, compound annual growth rate, if you look at revenue forward 2 years, only 7.3%, while EPS sits at 13.9%. So this is definitely not the high growth company, but this is a growing company that is very profitable. Now, like I said, they just reported their latest quarterly figures, and if you haven't had the time to read the transcript, well, you can use FinChat, which is a stock research platform, and it also tracks company-specific metrics. More recently, they added some extra cool features, so you can generate an AI overview for all of these transcripts right here, whether it's a conference call, earnings call, analyst talk, whatever. You get here a nice little summary, and then if you want, you can ask it a specific question. So let's say you have a question about travel trends. You can ask them about that. It will start to think a little bit and compile an answer. And this is what it looks like. So the transcripts indicate that Booking Holdings experienced healthy growth in room nights and gross bookings in the first quarter of 2025, benefiting from geographical diversification. At the start of the second quarter, the company is seeing stable levels of global leisure travel demand despite rising geopolitical and macroeconomic concerns. And then they note here the key observations. And like I said, FinChat is a platform that tracks company-specific metrics. So if we go here to financials, segments, and KPIs, we can look at, for example, room nights, rental car days, and then airline tickets as well. And this will show us very well, visually very appealing, how much this has grown. So room nights have grown by 7.4%, rental car by 4.6%, and airline tickets are up by 45.45% since the same quarter last year. Of course, you can drag this out for, let's say, a couple of years. Let's go back to the December quarter of 2019. And here we can see the compound annual growth rate for each of these segments. And of course, we can even see what has happened with the business in the worst period ever for them, which was basically the pandemic, when travel was dead. And that's where we can see, of course, the huge decline. And if you're interested to see more of that information yourself or every other company out there, there's a link down in the description and in the pinned comment, 25% off. That promotion runs up until Thursday. Then we're back to 15%. So do yourself a favor, try it out. You'll get anyways FinChat Pro for free for the next 2 weeks if you are a new member. So I highly suggest you go try it out. Now, we've seen the expected revenue growth, which again, not that high, not double digits. But what about free cash flow? Well, free cash flow for fiscal year 2025 is basically flat-ish, but then we see a small reacceleration, 14.5% growth in 2026, and then 8.4% in fiscal 2027, closing in on $10 billion in free cash flow. Now, last quarter, which was basically reported a day ago, we can see here, room nights up 7%, gross bookings is up 7% as well, revenue up 8%. Now GAAP net income and GAAP EPS is down 57% and 55%. Adjusted EPS did increase 22% year over year, and free cash flow is up 23% year over year. They said the following: I am pleased to report a good start of 2025, where healthy growth of room nights and gross bookings in the first quarter benefited from our globally diversified business. And this is the big deal here. It is a globally diversified business. So even in this geopolitical situation that we're in, well, if you're not willing to go to one country or another, for bookings, it doesn't matter, because you are going to spend that money on that platform, whether you're going to the US, to Mexico, to China, or whatever. If you're booking it on Booking, they'll make money. And you can clearly see this here. US revenue is a very, very small part of the overall revenue that they generate. Then all in all, looking at margins for the business. So for 2024, we've seen that it was 85.9%, free cash flow margin of 33.3%, which was, well, it's a bit lower than the peak year of 2022, but better than 2023. And here you can see that in 2020, they still generated $6.7 billion in revenue. Free cash flow margin was just negative 3%, but gross profit margin was still 70.3%. So even in the worst period ever for them, they were still, well, they didn't perform well, but you would think they would have performed much, much worse. As for Q2 guidance, they expect room nights to grow 5% at the midpoints year over year, gross bookings 11%, revenue 11% as well, and adjusted EBITDA between 13 to 16% year over year growth. As for full year guidance, they expect gross bookings to grow mid to high single digits, same for revenue, adjusted EBITDA to grow high single digits to low double digits, and adjusted EPS low to mid teens. So all in all, bookings here, another very strong quarter by them, a tremendous company to own. Moving on to company number 2, another very, very strong company here, American Express. American Express right now is experiencing a drawdown of around 19.5% from the most recent peak. It has a market cap of $187 billion, trailing 12 months PE of 18.5 times, and a forward one of 17 times. Now you might say, okay, American Express, such a quality business, gross margin 64.3%, free cash flow margin 18.3%, 18.2%, but those will be improving. You might say, okay, forward PE does look very cheap. Well, historically wise, it hasn't really been that expensive either. If we look at the growth, same thing here, forward 2 years, 8.1% or so, EPS growing faster than that at 14.2%. American Express did report their quarterly figures on April 17, so here again we have that AI-generated revenue for us. So American Express reported strong Q1 results with revenue up 8% year over year on an FX-adjusted basis to $17 billion, EPS up 9%. Total card member spending grew 6%, driven by goods and services, while T&E remained strong, particularly in restaurants and lodging. The company added 3.4 million new cards, with millennials and Gen Z comprising over 60% of new consumer accounts, and they've been focusing on those groups quite a lot more recently. Card fee growth was up 20% and credit performance remained excellent. And so this is what we got for the quarter. Discount revenue was up 5%, net card fees up 20% on a FX adjusted basis, that is, services fees up 5%, net interest income is up 11%, and revenues net of interest expense was up 8%. Now, if we look at free cash flow growth, first of all, if you can see, free cash flow has not really been stable that much in the last couple of years. It did peak here in 2022, but right now it's expected to grow 4.1% in fiscal 25, then followed by 2 consecutive years of just 3.1% year over year growth. Now, what has been impressive is this: the average fee per card since the December quarter of 2020 has grown at a compound annual growth rate of 11.1%. Last quarter, that has grown by 13.3%. It's very, very impressive. Now, looking at the margins for the business. So gross profit margin did decline. Of course, if we go all the way back to 2015, that was 73.9%. We're now at 64.3%, but revenue did increase by 101%. Free cash flow margin, like I said, did peak here in 2022 and has come down. CapEx did also increase. They did also acquire a company or two, I think, since 2019, and I think even in 2024. So we're now at 18.2% free cash flow margin, but that should increase. As for guidance, that remains unchanged, revenue growth of between 8 to 10% year over year, and EPS of between $15 to $15.5, subject to macroeconomic environment, but so far nothing has changed for them. Moving on to company number 3, probably the most obvious buy right now, and that's Alphabet. Yes, we've been talking a lot about Alphabet, but I guess we will talk about it more and more because it is very, very cheap in my opinion. Right now, market cap of $1.95 trillion. The current drawdown is, well, again, above 20%. We've had huge drawdowns in the last 3 years. If we look at margins, gross margins of 58.6%, free cash flow margin of 20.8%, a forward PE of 17.4 times, trailing 12 months of 17.9 times. Of course, historically, this has never been a very expensive stock, but I mean, right now we're trading below 20 times earnings. We're at 26.1 times price to free cash flow, 24.6 times forward. I mean, yeah, this is a very, very good business that is trading at very attractive prices. And so in case you missed my earnings review because you're not subscribed, so hit that subscribe button. And by the way, if you want to support me even further, do check out the link down in the description and the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So revenue increased 12% year over year. Income from operation is up 20%. Net income is up 46%. And diluted EPS is up 49% as well. I do believe they had some one-time impact that positively impact those numbers. As for the big question, right? Oh, search. How is search doing? Well, search did increase 10% year over year. YouTube ads increased 10% year over year. Google Network, which is the site where they got basically, well, framed as a monopoly, that's down 2%. It's not really that important for them anymore anyway, so yeah, that's down 2%. And then we've got here subscription platform and devices, that's up 19% year over year. And so operating margin for the Google services sits at 42.3%, and operating income sits above $32.6 billion. And this is what you get from a great business that is and continues to grow quite nicely year after year. Google search, where do you see Google search dying? I can't see that just yet. And of course, you have the Google Cloud. So Google Cloud, that's up 28.1% year over year. Margins there are very, very good. So even if Google search does come down a little bit, you still have an amazing business that is Google Cloud that I do expect to be, well, as big as an Azure, maybe in the future as big as an AWS. Right now, it is the smallest of the three, but it is one that is growing quite quickly. So yeah, you're getting here an amazing business that for some reason the market just doesn't like at the moment, whether it's because of the uncertainties around, well, LLMs, chatbots, or the lawsuits. Me personally, I just don't see how anyone can make the case that, okay, Chrome should be sold to someone else. Nobody else can take care of such an asset and run it in a profitable way other than Google. Then looking at free cash flow growth, free cash flow is expected to grow 5.1% in fiscal 2025. Remember, CapEx is still increasing. And then in fiscal 26 and 27, we see an acceleration in growth, 18.9% year over year in 2026, and then another 20.3% year over year growth in 2027 to reach $109.4 billion in free cash flow. And yeah, if we look at the margin side of things, things are looking a bit better for gross profit margin compared to where they were, let's say, in 2020. Free cash flow margin will improve as well. The business continues to grow and CapEx starts to normalize a little bit and does not increase each and every time. Oh, and of course, you get Waymo on top of it, which I do believe that the market, well, values Waymo at $0 right now when you buy a Google stock. They see substantial growth, or they've seen substantial growth in paid passenger trips, 250,000 a week, a 5x increase year over year. And they also said that AI overview search monetization is at the same rate as standard search. So yeah, pretty good. Last stock on the list is, of course, SoFi. So SoFi also recently reported their quarterly figures, beats across the board, guidance was raised. If this was any other company, it would have probably been up 20% or so, but no. During the day, it was up 8%, finished the day only up 1%, and now we're down 6.2% the day after. Now, SoFi stock is still up above 90% over the past 3 years. Over the past 12 months, for example, it still is up 83%, has a market cap of $14.6 billion. To me, this is one of the best run companies that I own in the fintech space, especially because, well, they've been doing extremely well. It's true that the stock might not have been performing as well as you thought. But again, if you look at the last 3 years, if you would have bought in 2022 or in 2023, you would be up, you would be beating the market. So yeah, the complaints here to me just don't make much sense. Of course, if you bought 5 years ago, then yeah, then if you bought the peak, let's say in 2021, then you would be in the red. But yeah, you still had plenty of time to buy this company at $6, at $7, at $8, and you'd be up quite a lot. Now, of course, with SoFi, you have some skeptics that are saying that this is a bank, should be trading at bank valuations, etc., etc. Well, yes, while the tech platform is not performing as expected just yet, why should we trade at the same price as a bank? Does a bank grow this fast? I don't think so. This was the figures from the last quarter. Record adjusted net revenue, record adjusted EBITDA, record fee-based revenue, record member growth, and record product growth as well. And management did raise 2025 guidance. Now, if we look at what the market is expecting this company to do, the market expects revenue to only increase 22.4% in fiscal 25, then only 19% in fiscal 26, and then just 15% in 2027. Up until now, the market analysts have been very, very wrong on SoFi. If we look at EPS, only 30 cents for the year, only 50 cents for next year. SoFi expects it to be closer to 67 cents, by the way, and then only 70 cents in fiscal 2027. So yeah, if you want to look at some metrics, do remember that those metrics are based on analyst expectations, and analysts have been wrong on SoFi time and time again. Now, if we look at member growth, this is what has happened over the last couple of years, basically a 10x since 2019. So quite good, I would say, quite good. If we look at the 3 business segments, so you've got the lending side, you have the tech platform, and you have financial services. Lending has seen a reacceleration in more recent quarters, financial services segment as well, and then some. That's where the loan platform business comes in. The tech platform has been quite flat. So that's the issue here. But, just so you know, the tech platform is the blue bars right here, which of course is much smaller than the lending side and the financial services one. Now you will say, yeah, okay, but we are giving it a higher multiple because this is a tech style of company, right? Well, let me explain in just a bit. First of all, if you look at total products, that has also increased, well, by 1,242% since December quarter of 2019. And the last couple of quarters, we've seen growth reaccelerate. Now, if we look at the financial services segment, if you look at financial services revenue and contribution profit, look at how fast this has grown over the past 2 years or so, 1.5 years. Contribution profit is up by 4,450%, and revenue is up 156.3%. And of course, we've seen an acceleration in growth for the contribution profit starting 2-3 quarters or so ago, thanks to the loan platform business. Now, the loan platform business is something that we didn't talk about 2 years ago. The tech platform we did, but now we have the loan platform business, which is growing much faster than the tech platform, that also has high margins, and yet people still complain. This thing just doesn't make any sense to me. I mean, look at this. Contribution profit for tech platform has basically been flat for the last 1.5 years, and revenue did increase a little bit. We are being flat already for 3 quarters now. But contribution profit for financial services segment, which again, loan platform business comes under that segment right here, and that's growing extremely fast, has higher margins. So why are we not cheering that we suddenly have a new product, a new segment of SoFi's business that is growing super fast and has higher margins, while we wait until this part of the business reaccelerate, which they told us is going to happen in 2026. I'm not going to go over all the other things here because I did a SoFi specific video, so that's up in the top right corner. But this again is a company that will stay misunderstood, I guess, until we reach new all-time highs, and then people will start buying again and say, oh, I knew it. Yeah, I've seen that before. So anyways, that's all I've got for you right now. This video has probably gone on for far too long, so apologies for that. But yeah, there is a lot to talk about in these types of videos. Again, do check out FinChat for 25% off, link in the description and in the pinned comment, and I'll see you all in the next one. Bye bye.